Right, guys. So we have been on this series for this is the 17th day of this teaching, and we will continue today. All right. So far we have talked about imbalances. We have talked about order blocks. I've talked about liquidity concepts and all those fun stuff, right? So let me use this opportunity to introduce what you call an institutional candle, right? Some people call it an institutional candle. Some people call it an FU candle. Some people call it um um so there are so many names they call it. Right. Some people call it an institutional candle. This is one of the foundational concepts of my trading, right? Some people call it institutional candle. Some people call it FU candle. You know what FU means, right? So FU candle, right? Some people call it all kinds of names. Right. Some people call it institutional funded candle. Right. Some people call it institutional funded candle. Right. So that is basically what some people call it. It's still the same thing, but for me, I like to call it institutional candle, right? So when we are talking about this concept, there is a logic behind it, and the logic behind it is that um the market is liquidity engineered, right? So this is candle, sorry, candle, right? Didn't see that on time, sorry for the mistake. All right. Okay. So we are trying to say that the market is liquidity engineered. What do I mean that market is liquidity engineered? We are trying to say that the market deliberately goes for stop losses or patterns, right? The market deliberately goes for lows before reversing to the opposite direction, right? So now what happens is that whenever the market, retail traders are taught that, when I mean retail traders, I mean retail minded. I don't mean that there are some of us that are not retail traders. Anyone using MT5 is a retail trader, right? They're using a broker, because if you're not a retail trader, you most likely using the liquidity server directly. So a retail minded trader will view this as what an equal top to go short, and then the market deliberately does this. Market does this. What happens? It now drops toward the downside. So now the market deliberately running this liquidity. It creates a candle, right? It creates a candle. That candle that pierces liquidity, right? And then takes the market down. It's also referred to as well the institutional candle, the FU candle, or the institutional funded candle. Right, so that candle was funded to run liquidity before reversing to the downside. Now, why is this done? This is done because for every buy order in the market has to balance it with the sell order, right? So when a smart money minded trader or a smart money or large fund is trying to get involved in the market, he obviously wants to target where there will be opposing liquidity. So if a smart money trader is looking to enter this trade now, he knows that many people putting their stop losses above here. So that's the only way to trigger your stop loss by doing what? By forcing price to go against you. So when he forces price to go against you, he has triggered your stops, and then he cannot take the opposite direction of your trade. So now he can sell short above here because now he has tripped all you guys to buy. You know that when you're in a trade, if you are actually using MT5, notice something. That when you take a trade and you take a stop loss and it was a sell position, notice that you will see MT5 show buy before it closes. Or check when you close your trade. If you're in a sell trade and you close it, it sounds like buy, and then you see a profit or loss. So whenever you take a loss or you hit a take profit, the opposite position is what happens. That is why if you sell here, you take a loss because you are buying back at a higher price. So if you sell and you hit your stop loss, automatically you have bought at a higher price. If you sell and they hit your TP, you have bought at a lower price. So if you sell something at a high price and buy at a low price, that is profit. If you sell at a low price and buy at a high price, that is loss. That is the reverse in the case. So you have to understand that. So if you're selling, your goal is to buy at a lower price, right? But when you now buy at a higher price, that is a loss for you. So smart money wants you to buy at a high price so they can sell to you at a high price, making you to take a loss. Why then they make profits? So that candle that runs liquidity before breaking structure to the downside is what we refer to as what? A liquidity sweep. As what? an institutional funded candle, right? So that exact candle that runs this and then breaks down. Now, note something. That an institutional funded candle could be one candle or it could be several candles. Some people call it order blocks, right? You can call it an order block. So the only thing is that it grabs liquidity. So not all order blocks grab liquidity, right? You should know that already. That it's not every order block that takes a liquidity. But this one, the intent is just to run liquidity before it was reversing price the opposite direction. Right? That is the main purpose of it. That is the main purpose of it. The purpose is to run liquidity before they were taking price the other side, right? So what do? You simply locate the candle that ran liquidity, you locate that exact candle, and then you extend it in time, right? You expect price to do to mitigate it. So price has to do what has to run back to it and then mitigate it, tap back into it before reversing to the downside. So you want to see price reverse into the liquidity point and then drop down. All right. That's how these things are engineered. It's very easy, very, very easy. So price will obviously come back there, tap into the candle. We call that mitigation. So when the candle is mitigated, what happens next? It drops to the downside, right? It drops to the downside. That's what we call a liquidity sweep and a mitigation, right? So that is it. So we have two kinds of institutional funded candles. Today, teaching might not be so long. We have two kinds of institutional funded candles. We have the bullish and the bearish, right? I've already given you guys what the bearish one looks like. So bullish will obviously be the reverse, right? We simply go run liquidity and then to the upside. Right, so we see the liquidity being run here. What do we see next? We see what? A break to the upside, right? A break to the upside. So this candle now becomes the area of interest. So you can extend that candle in time and expect price to do it, to come back there to mitigate it. So now this now becomes what your potential area of value or your area of interest or your point of interest, whatever the case may be, or whatever you call it, it's still the same thing. Right? Your point of interest is simply where you're expecting price to come back to mitigate. So when price comes back to your institutional candle, you now look for what? Confirmations. Now know something. This concept is used in two ways. All right. It is used in two ways. The first way that it is used is that you use it as what? A higher time frame POI, right? So you use it as a higher time frame POI. And the second way it is used is used as what? A lower time frame what? Confirmation. So you can use this concept both as a higher time frame POI and as a lower time frame confirmation, right? They are used in two ways, either as a higher time frame POI and a lower time frame confirmation. So that means that when price comes back to that POI, you can look for what in the same scenario, market doing the same thing here. This now becomes what? A lower time frame confirmation. So I've taught you guys a simple entry model now. The same thing that happened on the higher time frame has to also occur on the lower time frame. So when price comes back to that point of interest, you see price give that same setup, and then you can look for your buy positions with a smaller stop loss on the lower time frame, and then you look for what your you look for your trade. Right, same thing goes there. You can mark this time, you can mark that POI in time, and then what do? When price comes back inside there, so when price comes there, wait for market to break, and then you're in, right? You're in at that point of interest, right? Now, note that this instruction candle can also look in. This is the model A, right? This is the model A, it looks like. This is the model A. So the model B is also the same thing. Model B is the one that has an inducement, right? So model B has inducement. Model B looks like this. So model B is see price, run the liquidity, and then break, create some kind of inducement, and then before coming above. So this is model B. I have a solar candle there, right? Then you see price do something like this. So this model B. Model B price creates some kind of inducement before your original POI. So it creates another area of run. So price comes back there and then does what? Gives you a confirmation on the lower time frame. You can also give that model B too. So you can also see that model B occur here as well. So it happens. So you can see the lower time frame confirmation inside there as well. The same setup too. right? And then you take your sell off, right? So you can see this, you take your sell off, or you can also give model A entry here. Right? Price can still choose to give model A entry since we have already run inducement. So price can still choose to give model A entry, which is what? Which is price given that break or structure. I'll teach you guys about entries, don't worry. So you can see it too. So this will happen above this high. So when price hits a POI, then model B has occurred. And the same thing for a bullish scenario, right? Same thing for a bullish scenario. Model B is the one that has an inducement. So you see, the market creates that inducement before that POI, something like this, and then price comes back and then taps in that POI. So this now becomes that POI. That's area where liquidity was run. I think this is too deep, so let's take up a bit. All right, so market comes there, runs liquidity to the downside, creates some kind of inducement, and then price comes there. So these are the two ways which this candle model can form. So it's either it has an inducement or it doesn't have an inducement, right? Be mindful of that. Be mindful of that. So you should always consider the trend of the market. Note that you should look at the overall trend of the market, right? Don't just look for a model for model's sake or a pattern for pattern's sake, right? Always look for a kind of reason on the on the higher time frame why things should be happening. So let's go to the 3-hour chart and see if you can find something of that sort. All right, let's see if we can find this is a pair that we have not been using. Let us see something like let's use something like USD chef. All right. Okay. Let's use the Oanda. Right. So you can see a very clear example here. It's a 3-hour chart, right? So can you see how price around liquidity? We are bearish, right? So market was overall bearish, right? Market was overall bearish. We tapped into this POI, this imbalance here. So market ran liquidity here and then broke to the downside. So you can see how price ran liquidity here and then what? Broke to the downside. So you can see your institutional candle here. This is the institutional candle. That you can see how price came nicely into it. Although I'm not sure there was a lower time frame confirmation here. Let's just check 15 minutes to see there was a lower time frame confirmation inside there. But I think there was, yeah, there was. So you can see it already. Can you see? Markets came to our 3-hour institutional candle. What happened? We saw another one. So market broke structure again here. Market broke another structure here. Market also do what? Ran liquidity ran here. So now in this example, this is where you see different candles. Now, if I was to judge this, I would not say that this is the institutional candle because the move started somewhere around there. If you look, let's zoom a bit. Where did the move start? It started somewhere around the year or year. So it was the move started took a liquidity. So if you ask me if I were trying to streamline this, I will start from the low of this candle to the top. So that time becomes my institutional candle. So from that last retracement to what the push up to liquidity run. So that becomes my POI. So if I was to take this sell now, how would I do it? So instead of using that 3-hour stop loss, now you have a smaller stop loss. So you can now simply mark this as your entry. You just simply put as your entry. And now this now becomes what? Your stop loss, just above here. Right, very simple. So you're not using that big stop loss anymore, right? So that's the purpose of lower time frame entries. It helps to reduce stop loss. So this now becomes your entry. And that becomes your stop loss. So obviously targeting this low as a fixed take profit, this low will be your first TP. So that low for this will be like 1:1.6. So this is about 1:2. So around there, you can see our price actually melted down. So in total, you should have made about 1:5. And you can use the higher time frame to pick your take profits. So we go back to the 3-hour chart again. So that's a 3-hour chart. So use it. So let me go back to where I was. Let me make the visibility on the 3-hour charts. All right. So let me just make the visibility on the 3 hours. All right. So you can show. All right. So you can see on the 3 hour now. Okay. So you can see it. So can use the 3 hour to choose a stop loss. So this obviously using this low as a stop loss. So sorry, your take profit. So there will be like 1:5.3. So that will be your overall take profit, a low here. Or you can use the body of the candle. This is the body of the candle here because there will be some kind of volatility here. All right, so this can also be a take profit. This body of the candle there, 1:4. All right, so you can use the body of the week. Right. Sometimes I like to use the body of the candle for my take profits because sometimes it tends to reverse there. So this can be a very good take profit just there. Right. So 1:4.3. That was a very easy trade. Very easy, right? Anyone can take that. Right. I've shown you guys how to do this on the higher time frame and then the lower time frame. So let us see if you can see another example, and then we call it a day. I'll still go to 3 hours time frame. You have to use the high time frame to spot your area of interest before you look for confirmations. Right? We're looking for where the market printed an institutional candle, and then we saw price, rally to the down to the overall area. All right. This market has just been doing up and down, up and down, up and down. Right? See another one here. Got this big candle. Can you see this big candle around liquidity here? And then when some market broke to the upside, so you can actually highlight this as a sensational candle. So I say our price was broke up, but it was not dancing inside it, and then somehow price found its way. This 29th of April, 29th of April. So let me go to the lower time frame to get it. 15 minutes charts. So let's go to 29th of April, April 29th. All right, 29th April. So go to. So you can see market this is 15 minutes chart of that point of interest. So if you ask me, I think that was a confirmation here. So market did the same thing as well. We ran this liquidity here. We broke above this high. So we broke above the structural high here. So you can see how this is perfect. Right? You can see this is perfect. This was a confirmation of 15 minutes chart. Right? So we saw where's the international candle this last time move. So if I had to quantify it, I would say from somewhere around there. Because it was the last candle before they push down. So it was the last retracement. The high of this candle was the last retracement before the liquidity was on. So this is my POI. So you can see how that was very perfect hit, and the market was rallied higher. You can see the inducement that was formed. See all these inducements here. So if you bought here, your stop loss should have been above, maybe below this low here, right? So this has been a very nice trade. And this is a very easy one using a concept of institutional candles, right? So 1:2. This previous high was like 1:2. Or a bit above 1:2, just above this high here, and then the market bought like crazy, right? Bought crazy. So I think a total of 1:1:to 6.9 before reversing, right? So obviously you have to use the higher time frame to select your your take profits. So let's see how would have chosen our take profits. Right, so I can also use a fib extension to select take profits. You can take the fib 2 from this point to that point. So this can be your take profit minus. I told you guys about fib 2. I use it for take profits. So see there, right there. So this will be a very good take profit. This minus 0.27. That's a profit extension level. All right. So this is basically how you're able to trade institutional candles, right? I think I'll give you guys 2 examples. So I would like you guys to use your own time to back test and study. Look for more examples of this on your own chart, right? Look for more examples of this. It's very easy to trade. Yeah. So if you would like to join our paid group is still ongoing, right? There's still a lot more in-depth teaching, in-depth attention. So use the promo code June with the link in the description to join our paid group. Right, you get a 20% off. Right, if you use the promo code June, just use the link in the description to make a payment to join us, because in our paid group there's actually more, like a lot more. Right, there's a lot more than this. longer videos, personal life classes. You can ask questions where you're not clear, all of those fun stuff, right? But on YouTube, you can't ask questions because this is a free platform, right? So you can also network with other traders in our peer group where you have other traders you can network with, you can talk with them, ask questions, and all those important stuff, right? We work as a team, right? So that's basically it. So use the link in the description to join the paid mentorship if you wish to join us. It's very affordable, right? So just use the link to join us. Have a wonderful day. Cheers and God bless.